So welcome guys to another presentation from FX Pesa. With me is my colleague, Nobert from Uganda. So Nobert Robert, yeah? So what a rhyme. Nobert, welcome.
Thank you so much, Robert. I'm so excited and happy to be here today with you. Yeah, thank you.
Awesome. Thank you. So today, guys, we are going to look at a topic that most traders struggle with, and most traders will say 80% of trading is the topic we're discussing today, which is trading psychology. And I'm glad that at least now we have Nobert, and let's hear maybe some outlook from my Ugandan. You know, we as traders in Kenya, we've been thinking about trading in a certain sphere. So I'm sure Nobert also has some few pointers, and I believe that he'll be so instrumental in sharing the same with us. So Nobert, hello, there's some guys who are joining. Hi Mercy, karibu sana, welcome to this presentation. I really love it, Nobert. I really love it when ladies join these sessions because, you know, whatever we'll be discussing today has some outlook when it comes to ladies. You know, ladies at the end of the day, they tend to have more structured way of doing things, not so much driven by emotions when it comes to trading. And I think that's weird because normally it's always, some will argue that you'll see ladies will want to make irrational decisions, but it's totally different, especially if you're looking at Japan. If you look at the women traders in Japan, there's a whole group of traders called the housewives of Japan, right?
Wow.
Watanabe. These ladies, wow, these ladies are traders. They kill it in the market, right? So
amazing.
It's always good to see more guys joining the session. So we'll start off with trading psychology, guys, and this is all about having a trader's mindset. If there's anything that you'll ever get to do in this business and do yourself a favor, is having being in the right mental state by making sure that you have that trader's mindset. So Nobert will kickstart this presentation for us. Nobert, you're able to share your screen?
Yes, I believe I am. Let me just do that right away. Okay.
Awesome.
Okay, I hope you can see my screen. So
yes, it's quite visible.
Awesome. All right. Yeah, so thank you so much, Robert. To the listeners and the viewers out there, thank you so much for joining us today for a very, very interesting session on trading psychology, which I believe is a very, very important area for traders. As most of you know, the act of trading is something that is a very instant activity. It's just a click of a button. So there's so much else that goes into the activity of investing in the financial markets, and trading psychology is one of them. If not, I would say one of the most important ones. So today we are going to talk about trading psychology, and I'll be discussing it through with Robert. Yeah. Okay. All right, so this is going to be a breakdown of what we're going to go through. First, we're going to get a good understanding of what trading psychology is. Then we'll look at the practical examples of the trading psychology, the different types of trading psychology that we have. Then as well, also how to develop a solid trading mindset. And then we'll also share a few resources which you can access. These resources are from the Wiley Trading series that you can continuously read to help you better understand how it is you can develop a very strong trading mindset as you go along. Yeah, so trading psychology is essentially just the study or the understanding of the emotional and mental factors that affect a trader's decision making. There are so many things that go into emotions that we have to have a good understanding of, and how we can as human beings, you know, emotions is something that we have. It's an inherent characteristic as a human being. You can't avoid it. And there are various types of emotions. So it's always important for us to understand what they are and how we can have a good grip of them in the trading arena. This is just a quote from a book by Brett Sternberger. Brett Sternberger is a trader. He's also been a lecturer on various medium in the US. You can go and search him up. And he quotes in his book on enhancing trader performance that competence precedes confidence, and winning mindsets result from mastery and not the reverse. Yeah, Robert, I don't know what you think about that.
Wow. Okay.
Yes.
That's something.
Yeah.
You know, at the end of the day, when
Yes.
you're coming into this trading market, into the business,
Yes.
we all have our own emotions. We all have our biases. We all have our own beliefs. We all have our own attitudes, you know, on trading decisions. So one of the ways that we really need to capture is that you need to look at ways of developing strategies to manage them effectively, right? So if you look at what this guy is saying, basically you're looking at competence that precedes confidence. Like, how competent are you to be able to overcome even the emotions that come into the trading, your biases? And that means you must come up with something that really is able to capture your mindset, so that you're not so much caught up in maybe the beliefs that you have on the market. Let's say you have that belief that the market will always come down. You know how people say traders at the end of the day, the market will always come back, right? So they remove their stop loss and say the market will always. That's a belief. But the market will not always come back, right? So at times the market will take out your money before it really comes back. So I think that's something. So it involves understanding how human emotions such as fear, greed, and anxiety can impact trading decisions, and how traders can manage these emotions to make better investment decisions. I mean, at the end of the day, there's also another emotion here, Nobert. Hope.
Oh yes, the hope strategy.
The hope strategy, my friend. Yeah, there are guys who actually they always saying, I hope the market comes down. I hope this stop loss. Let me remove this stop loss, because you know all these things. These are some of the things that I know most traders will be resonating pretty well with what we are discussing, because this is now the trader's mindset. You know, because if without these, then there's a high probability that you will not ace it. So trading psychology is an essential aspect of successful trading, as it can have a significant impact on a trader's ability to make rational decisions and manage risk effectively. Nobert, it's not just about making decisions.
They have to be rational decisions. That's true.
They must be rational decisions. And then once you've made those rational decisions, you must also know there's something called risk management. How are you managing your risks at the end of the day?
And meanwhile, just to add on that, you know, when we speak about rationality, it's important for us on our end, because most of the time, or if not all the time, the market is irrational. That's how it will work. You can tell from how it reacts to news, and sometimes, of course, usually the kind of patterns we have seen with the price prints, they do not act in a rational way. So on our end, we have to look at how long are we able to stay in amidst all this irrationality. So it's in that part of rational decision making is very important, because we are looking at how can we remain rational for as long as the market remains irrational. So that's on that part, it's very, very important that whatever decision we are making, we have to keep in mind that irrationality will always reign, but on our end, we are remaining as rational as possible. So that is very, very crucial.
Yes, Norbert, and you see, at the end of the day, there's also the aspect of impulsive decisions, right? And we all know most of these impulsive decisions, combine that with the irrational decisions, they'll always lead to losses. right? Because you don't know, you don't have a structured way of managing whatever will come into the market. So successful traders, and I think this is where now we really need to buttress the successful traders. They should be able to manage their emotions, have a look, remain disciplined and focused, and all these manner of things. But currently, let's continue with maybe this other part where we say the financial markets, they are complex and unpredictable, not 100%. Yeah. And traders need to be able to control their emotions and remain focused on the trading strategy to succeed. Listen, guys, if there's anyone who has ever lied to us that the market is predictable, well, unfortunately, if you ever come in with a mentality of predicting the market, no, but like, for example, in my case, this is something probably you'll be capturing in Uganda. I hate using the word prediction in my trades. That I'm predicting the market will move in a certain direction. Why? The moment you start using the word predicting, there's a trader friend of mine who said you get caught up in some ego because you feel kind of unbeatable by use of the word prediction. So personally, I choose the word anticipate. To me, it's more cautionary using the word anticipate more than predict, because predict brings in a certain level of overconfidence, and the moment, guys, you bring in overconfidence into the system, then it's just a matter of when, not if.
Yeah, that's really true. As you know, of course, I mean, when you say anticipate, I think really that's just as you've put it. When we do technical analysis, when you do any sort of analysis, we are just trying to determine what is called a high probability setup, or determine a high probability entry for us. So if it's, say, maybe 80% or 90% probability, then that of course usually should work in our favor. The reason why it's not 100% is that it's not guaranteed, and that is why we always have to think about how we can stop ourselves from losing a potential amount of money that can maybe set us back in our journey of making it in these markets. Yeah, so it's very important that we keep that in mind as traders. Yeah.
Yes. So on to the next slide. Emotional trading psychology. Here we'll be looking at fear and greed, and I believe if there's anything that crushes most traders is this. Personally, I've been a victim of this until I understood that the market I think every trader who's worth their salt, any trader who's honest with themselves, they'll agree at some point in time, fear and greed will always catch up with you. And some of these things you just have to find a way of controlling them, and this is why I believe one is, of course, you have to have that trading plan that is able to outline everything, that before you enter a trade, before you exit a trade, how you manage your trades. You're able to register, maybe even using a trading journal. You're able to say, you know what, last year you were able to look at your journal and say, hey, last year when I was taking my trades, apparently I used to be emotional. I used to have fear. Then all of a sudden you're able to track your progression, right? Slowly and slowly, and you're able to say, oh, okay, by there, I've made quite some progress with regard to this. So fear and greed can have a significant impact on CFD trading. Fear can cause traders to close out positions too early or avoid taking trades altogether, while greed can lead to overtrading and excessive risk trading. What's your take on avoiding taking trades altogether?
Yeah, I think the first one is talking about now the fear of not being confident enough, I would say. So now this other one of avoiding taking trades altogether is actually not being confident as well, because even when you have a high probability setup, even when like this particular trade, if it's maybe like a swing trade, it sticks to all your boxes, but there's just something in you saying like you're just being too risk averse, I would say, and trading is not the way trading is it's not for completely risk averse people. You know, I mean, talk to a business person, talk to anyone who is in the game of making money. You have to step out of your comfort zone and say, you know what, let me prepare properly for what's coming, you know, and as long as I'm safe, you know, but not too safe enough, then I can take the risk, you see. So avoiding taking trades altogether, you're missing out on making money, guys. You know, we're in this business to make money. So if the thing is looking like it's going to work in our favor, first of all is, are we going to be able not to completely lose our account from this trade? Shall we able to make more at least than we are going to lose? Then let's, you know, take the trade. Yeah, so having that fear of not taking trades, you know, you'll miss out on opportunities even when you know it's going to work out, you know. And then also there's this mentality of whereby now you've completely missed out on a trade and then you're getting into it too late, you know. So that also needs to be avoided. If you miss out on a really good opportunity, guys, it will always come back. Trust me, it always comes back. You will see the same exact setup happening a month from now, couple of weeks from now, and you will know when you see it, and you'll definitely take it and make money from it. Yeah. So that's what I can say on that, Robert. Yeah.
No, but to buttress your point, there's a phrase that I normally use here in Thika.
Yes.
I tell guys, trading opportunities are like a bus. There'll always be a next bus coming.
Yeah. Exactly.
You just need to be patient. You just need to be patient. Just make sure that you know that, yes, that trade has gone without you, but always ask yourself, if that trade maybe was bullish, right? And probably came 5 pips shy of your entry, didn't take your, you are not able to hop into that trade, and, you know, the trade shot up. Always look at the possibilities that the market could also still come back.
Yes.
And I know most traders have encountered this issue where, like, the moment you've missed out your entry with, let's say, 5 pips, you start chasing that trade, you know, when it's like all of a sudden you realize the trade is almost 10 pips in profit, 10 pips away from even the desired area. And then all of a sudden you're caught up with FOMO, fear of missing out, you join the trade. The moment you join the trade, then the market decides, you know what, let's go back down there. Let's go to his position. Let's go back to his entry, his maybe buy limit order, pending order. Then all of a sudden, you know, Nobert will agree, in moments where FOMO has struck, because of that whole, you know, you want to compensate for the pips that went, the trade, the pips, the trade that went without you, then you end up increasing your lot size. Because you want to overcome, you know, the setup. You want to make some good money. Because since, you know, the assumption here is that you missed out on the pips. So let me do this. Let me increase the lot size so that I'm able to.
See, another thing also is whenever for you're trading for urgency, that is when you're going to be forced to. No one who doesn't want money immediately is going to do that.
Yeah.
No one who wants money immediately is going to do that. The only reason why I am going to be forced to increase my lot sizes to make more money or to chase a certain trend is that I want money right now. And that is not the mentality you need in trading. Because there is no guarantee that the market will give you what you want right now. Just in case Biden comes out and speaks, or you have Lagarde having emergency meetup on something, and you're stuck in a euro trade and you wanted your money right away, you're not going to get your money right away, guys. So that I think when you bring in that aspect of increasing lot sizes, I think it tends to happen for traders that want to make money immediately. And of course, the market is, you cannot force the market to give you money, guys. You take what it has given you, and you should be content with that. And then the next time you come, then maybe perhaps you can get more. Yeah.
These other points, Nobert, avoid taking trades altogether. Another scenario where you would avoid taking trades altogether is when you've suffered a losing streak. Let's
Oh,
say you
yes.
had a losing streak of a five trades
Yes.
losing streak.
Yeah.
Then all of a sudden, your trades, according to your trading plan, they come to your predefined entry. Then, due to that fear, that
Yes.
you see, the mind is quite interesting, because
Yeah.
anytime you have losses, financial losses, it treats that as pain. So
Yes.
the next time
Yeah.
that trade comes to your predefined entry, and clearly this is an entry where you've backtested before and it has
Yes.
worked out. It's maybe a double bottom with a
Yes.
confirmation of a strong support.
Yeah.
Maybe you have a confirmation of even a reversal candle. You have a hammer. But then again, you still caught up in the fear, and you're not able to press
Yeah.
that push buy button, sell button. So
That is true.
these are challenges that you'll face, but as we will cover later towards the end, we will see how a trading plan will come in handy to
Yeah.
help you deal with all this. So while greed can lead to over trading and excessive risk trading, guys, greed is something that, every trader has encountered this,
Oh, yes.
and especially Nobert, where you said, like, especially when let's say you have a pending bill in most cases, like
Yeah.
it's towards the end of the month, and maybe your trading capital
The
is the same
urgency.
capital you're supposed to pay to pay
Yeah.
the rent with. You end up taking bigger positions, but we all know how they end up. In most cases, you lose more money than you had in your trading account, and you'll maybe even blow the account, or even get into revenge trading to try and overcome the losses. Yeah, it's a whole cycle. It's a whole vicious cycle. So we'll have a look at our trading plan and see how you're able to plan your trades and trade the plan. Yeah,
Yes,
so maybe, Nobert, you can look at emotional bias.
Yes. So emotional bias is basically the tendency to let emotions influence decision making rather than relying on data and analysis. Yeah. So for those of you who use trade, I think you can relate with this. Rather than focus on data, we tend to perhaps maybe think that, okay, fine, I've been waiting for this particular setup for some time, and it seems to have shown that perhaps I can get in. I can give a scenario, for instance, like say if it's maybe like US CPI, and basically, of course, I'm sure most traders know we basically know that when inflation has been coming in lower, perhaps over the course of the months, we've been knowing that has been favoring the risky assets. So the pound, dollar, those ones are buys, the euro, dollar, and all of these. And then, of course, rather than when we see, for instance, like we see a CPI print that is really hot, or it has come in much higher than anticipated, we know perhaps that's supposed to make maybe DXY sell or the dollar to sell. But because we somehow think that, I've been seeing perhaps maybe the way this candle has been appearing, and maybe we have seen a really good green candle, a really good red candle for us to buy or sell. We give in to that. You see, we have that adrenaline telling us, let's get in with this trade. But we are seeing maybe data has come out, not really hot or not too cold, it's just mixed. And you guys know usually when data is mixed, sometimes it's not always good to trade, because we want to see what is going to happen, what are the market makers going to be up to with this kind of move. So rather than focus on what we are seeing with the data, we tend to have this mentality that perhaps maybe I feel maybe like euro dollar is a buy, I feel maybe like euro dollar is a sell, that kind of thing. So guys, if your analysis tells you that it's mixed data, maybe let's wait for some kind of digest by a Fed speaker, or maybe just to see how the market is going to play out, maybe at the high of the day or at the low of the day. If maybe we have been seeing a pattern forming, just to see basically, is that in line with our analysis? Because if it's in line with analysis, and if it's in line with our assessment of our data being mixed, then we should give it a pause and see. But if we put all that aside and be like, okay, fine, it's just me and the candles now, guys, if we do that, then of course now we are giving into our emotions, and we do not have a clear criteria for decision making on our trading, and that of course then affects our trading results. So it's important that we focus solely on our strategy with this. Yeah, that's what I have to say. Robert, I don't know if you have anything else to add.
I just wanted to say, like, as traders, we need to let go of the need to be right. Like,
yes,
Just allow data to speak, allow your trading plan to speak, allow whatever it is that you had planned out to speak, right? And then also, of course, you must make sure that you're not so rigid as a trader. Learn from your mistakes because, I mean, this is just like life. Mistakes are inevitable in trading, but they can also act as very valuable learning opportunities, right? So, and the only time they become valuable learning opportunities is when you review your trades and identify areas where you can improve. If, let's say, you're into fundamental analysis, you can decide, you know what, most of my losses have been due to fundamental analysis. I've been looking at, I've been trading so much news and all the data that comes from. What about stay away from news for that moment? Just review everything and just make sure that you understand that it's all about the process, but it's not just about the outcome. The outcome, the win or the loss, that's an outcome. But focus on the long-term process, such that one trade should never make or break you. You shouldn't have a trade where like you're making so much losses that you have heavy drawdown, or even you're making so much profit that you end up being so happy, and of course the happiness comes in with so many other emotions. You become reckless, you become overconfident, you blow your money, the profits you had made, the market takes that away, and it's a vicious cycle, unfortunately.
Yeah, actually, it's really good you brought that in, because happiness is also an emotion, and we have to make sure that even when we're having a winning streak, that shouldn't stop us from keeping cautious. Because whenever you're having a winning streak and you're not cautious, you'll immediately get into a time of getting into a drawdown, for some time. So it's important that you're cautious. So even when things are going well for you with this strategy, and also in the time of the market, make sure that you follow your plan and your analysis, and that you're remaining as cautious as possible. Yeah,
awesome. So mental trading psychology, mental states such as focus, discipline, and patience can impact a trader's ability to make rational decisions and manage risk effectively. Traders who lack focus or discipline may be more likely to make impulsive decisions or take on too much risks. Remember, guys, at the end of the day, always treat this as a business. Treat this with the seriousness that it deserves, because at the end of the day, you're making a career out of this. Let's not just look at the monetary gains. I know money is important, but look at the long-term opportunities in the market. Maybe, as we grow, as the Kenyan space and the Ugandan space grows, we could have, you see how the Western world hedge funds have been on an increase, all these funds, these are opportunities for us, and you can even become professional on that end. So you should make sure that you have that focus and discipline. So what do you think? What's your take, maybe? Nobert?
Yeah, of course, impulsiveness, obviously. That's something I think that you've really explained really well. We shouldn't, impulsiveness basically is taking decisions, or taking trades, on spot without really giving them thought. Or even when we're not supposed to be in the markets, we somehow maybe want to go check on our phones and look at the chart and be like, man, look at GU. GU is setting itself up for a really good move. You take that trade. That's impulsiveness. So focus only on the time that you're supposed to trade. When you're done trading for the day, don't get back into the markets. The markets are open Monday to Friday, guys. If you trade Monday and perhaps maybe you've hit your profit target for the day, you can always go back in the next day. If the next day doesn't look good, wait for the next day after that. Yeah. So, having to chase trades, stalking the market also, those are not good habits. and those also at the end lead to impulsive decisions. Yeah, which of course,
Yes. So
at the end,
true. Yeah, just be patient. Successful trading requires one to be patient and disciplined, of course. Just avoid the impulsive decisions and wait for the right opportunities to present themselves. This is where, like, you must look at areas where you've already predefined, you've backtested, and you've said, I'm waiting for these opportunities at area A because of 1, 2, 3, 4, 5. So yeah, behavioral trading psychology, you have overconfidence. Traders may become overly confident in their abilities, leading them to take on too much risk or make hasty decisions without proper analysis. I think we've covered this.
yeah,
No, but this is
yeah,
a risk, especially for the experienced traders. Yeah, you become so overconfident because you've been on a winning streak or winning streaks. So this is what I normally say. No, but we know,
yeah.
as human beings, we must find a hack. A way to go around these aspects of greed. So I always tell people, anytime you've realized you've been on a winning streak and you have that urge to increase your lot size so that you can make more money, take a pause, withdraw the money that you have, by all means, just withdraw some money, buy something, something physical, so that you can say, you know what, you guys, by the way, this is money I've bought from my trading. So you're able to, it's more of a reward. You're rewarding your brain. So just in case you end up, becoming overconfident later and increase your lot size and you take a hit in your account, you're able to look at something that you bought with your profits when you are not greedy and say, you know what, trading has been working for me and I can see the results. So that way you're able to conquer the element of pain through a reward.
Robert, it's good you've mentioned that. It's something I encourage to the traders that I'm in a group with, and just basically to anyone who wants to go into trading. You need to, if say for instance, you need to have like a plan for how your trading account is not a savings account, guys. You trade. Once you make money trading, take a portion of this money that you've made, take it out of the account, put it onto a savings account. You could put it onto a unit trust, do something with it. If you're investing, if you have another investment you're doing, it could be a business or it could be maybe whatever it is. Have a portion of money that you take out. Don't keep all your money on your trading account. I can give you a story. Once I was on a forum, and on this forum, I mean, this guy had put almost, I think, I don't know, was it close to almost 13,000 euros? And it was, I would say, almost all his life savings was on his trading account.
Wow.
And when he got into a losing streak, he pretty much lost his entire, I wouldn't say net worth, of course, but most of his life savings. Yeah. So your trading account is not supposed to act as a savings account. Use it as one of your other ways you make money with. Whenever you make money, use it to do other things. Use it to invest, use it to save, do something with that money. Just like Robert has said, if there's something that you really want to do with yourself, it could be maybe a course you want to go and study or a trip you want to take it with that money, guys. You're in the markets, you give time to this. And most times we don't really want to say this, but time is also cost. Time is money, guys. So the moment you're taking time in the markets, that is also money. So pay yourself. Don't keep all the money on your trading account and think, let me keep it there. So once you make money, take that money out, do something with it, make more money. Yeah, go ahead like that. I think that's a really good point you brought out, Robert.
Pay yourself. Awesome. Clearly.
Yeah, exactly.
So FOMO, we have fear of missing out, can also impact CFD trading. Traders may feel the need to take on more risk by opening trades without proper or even prior analysis due to the fear of missing out on potential profits. Guys, once again, the only way to treat FOMO, remember, there's always, just like a bus, there'll always be another trading opportunity coming in. The disadvantage of FOMO is that, and most traders who are listening to this webinar will agree with me, the moment you've been caught up in FOMO, you've increased your lot size, you've taken a hit, maybe you even get to the whole vicious cycle of revenge trading, you take a hit, the moment you've blown your account, that's when all the best possible entries, best possible trading setups present themselves. That's when you don't even have capital, you don't have money to fund your account, but then
Yeah.
all you're seeing is money. All you can see is money, 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 money. So guys, let's deal with FOMO by looking at it in that angle. Just like
Yes.
there's always another bus coming, it may not be today, it may not be tomorrow, but then again, the moment it comes, it will provide you with those ideal setups that you're looking for, the ones that give you an edge in the market. So loss aversion, this is a tendency to avoid losses more than achieving gains. Traders may become too focused on avoiding losses, leading them to close out positions too early or avoid taking trades that could be profitable. I think personally, Nobert, this is where, like, especially if you don't trust your trading system, I think the error here will be you've not really backtested your trading system. You've not played around with your demo, or if you did, you used inconsistent lot sizes. So let's say you're using a standard lot size. And you know clearly pretty well that when you start funding your account, you'll not have such capital in the beginning. So why don't you start small, grow your account with a 0.01. With FX Pesa, you can actually reduce your account size, to even $250, right? Just work with that amount, because we all know if you're using, let's say, if you have an account, let me tackle actually this question that has been asked here in line with that by J Squad TV. J Squad, if you're looking at, maybe if you have a $150 account, the maximum lot size you should be using here is 0.01, because we all know $100 is 0.01. If you're going to $200, you're using 0.02. So you should actually look at one asset, maybe look at high probability trades in this, so that with your capital, you're able to look for opportunities that line up clearly, that give you an edge, right? Because there'll always be those setups that will give you a high probability win, and they give you an edge in your trading business. So when it comes to trading other asset classes, this will really apply if you have a bigger account, so that you're not taking on huge positions. Because if, let's say, you're taking $150 account, right? So if you're maybe taking the recommended risk of 2 to 5%, you see, you really need to work around that and see your lot size. Really, you can't go way past 0.03, right? So make sure that once again, undercapitalization, I don't know, but this is something, undercapitalization is something that is a big hindrance, and it affects most businesses, not just in trading.
Yeah, actually, I'm thinking I've seen that question. The gentleman of 150 USD, just Squad TV.
Yes.
Yeah,
yes.
I think you've answered it really well. Your lot size should, of course, I would say, 0.1, 0.02 should be, I think, adequate enough for that size of account. And of course, you also have to look at how much money. I mean, the benchmark is 1%. You shouldn't risk more than 1% of your account. And of course, I would think since the account is not that big, you shouldn't really take so many positions. I would say maybe at any given time, perhaps maybe have 2 positions open. There are so many strategies you could use for that size of account. You could, look for a swing trade on GU after looking at, if it hasn't, depending on what you're using, if you're using moving averages, and maybe they seem to have crossed at a certain point for a reversal, you could open up a swing there. You could easily grow that account just by using only swing trades. Just take one trade maybe every 2 weeks or 3 weeks till you get your size of account up. You could also look at scalping. Scalping could also help grow the account. Again, of course, make sure that you're keeping within your risk parameters for the account. So you shouldn't be limited on your size of account. $150 is perfect. You can still be able to trade sustainably with that account. And you could also look for a concept of dollar cost averaging. So on the $150, make sure you keep adding money to the account, so that you can, keep, as you're making money on the $150 account, you can also keep adding money so that your account size also grows entirely. Yeah. Thank you so much.
Awesome, Norbert, you've covered that pretty well. So maybe you can look at confirmation bias. Maybe you can handle that.
Yeah, so trades their confirmation bias may be biased towards certain CFD assets, as well as trading strategies, leading them to make decisions based on these biases rather than objective analysis. Yeah, so confirmation bias is a really widely shared concept in finance and in behavioral finance. And basically, I can explain it in simple terms by, if you've spoken to people who seem like they are right on almost everything, like they do not want you to bring some kind of like argument to whatever they are saying, because they seem they are right, you know. And that's basically what confirmation means. Somehow you think you're right on something 100%, and that when someone brings a counter argument to whatever it is you're right about, they are wrong. And that's confirmation bias. Yeah, so, and
Awesome.
it's you know, the market is dynamic, and having confirmation bias is not a good thing. You have to be ready to be objective in your approach to that, to whatever it is you're trading. It could be GU, even when it seems as though your strategy is telling you that maybe this is a really good buy. Have some room for you to maybe doubt your analysis, and look at ways of perhaps maybe where you could be wrong, because that of course then makes your analysis better. If you look for ways maybe where you might be wrong. Yeah, so it's important that, you know, we keep having that kind of like, you know, I think it could be this, I think it could be that, you know, listen to what someone is saying, even when you're not going to take to use whatever it is they're advising, but you've already taken the argument and you also think about it as a possibility, you know, in that particular asset that you're trading. Yeah, that's what I have to say on that, Robert.
Thank you. Thank you. That's well captured. So, guys, remember, at the end of the day, you as a trader, you must have that mindset. Always make sure that whenever you're taking trades, don't be too confident, because at the end of the day, that will destroy you, because you tend to be reckless the moment you're overconfident. Yeah. So the next thing we're looking at is behavioral trading psychology. We've buttressed this point enough. Create a trading plan. There's a simple line I normally tend to use. Plan your trades, trade the plan. Simple.
Yeah, I think that's pretty much it, Robert.
Yeah, that's
Yeah,
it,
that's
man.
it. Yeah,
Because the moment you're planning your trades, you're not emotionally involved, right?
yeah,
So that is a plan that you've worked out when the markets maybe it was even on a weekend. So you're able to leverage
yeah,
on that trading plan to take your trades. And then there's also practice patience. Guys, if there's anything that you need to do is practice patience. This is something that unfortunately, in all honesty, patience comes with a few blown accounts. I don't know why. That's when you decide, you know what, this
oh
pain is
boy,
too much. This is too
yeah,
much. Let me be patient. Let me learn to be patient for the next setup. Then, of course,
yeah,
there's developing emotional intelligence. Nobert covered that pretty well.
yeah,
Practice risk management. Guys, risk management. You are a risk manager more than a trader. Anytime you come into this business, consider yourself a risk manager, not a trader. You're looking at the underbelly. What could go wrong? Look at the possibilities of going wrong. Know that at some point in time you could be the best trader, but there are times the news will come, some weird news could come out, right? And maybe if you had taken a bigger position, then you know that would hit your account pretty badly. And then of course, maintain a positive attitude, guys. This is something that you have to do, because if you don't maintain a positive attitude, then your mindset will be blown away. Like you'll just
yeah,
be lost. And actually, I always say the market is always changing, no but right. It's dynamic, like you just pointed out. Traders should approach trading, I always believe, with some form of humility and willingness to learn and adapt. That's the most important. You're flexible. You're just like the market. Be flexible, just like the market.
yeah. We'll say the Robert on that. Yeah, yeah. That's really it. Yeah,
Maybe we can look at the resources over here, Nobert.
yeah. Yeah, there are just two resources that I've added here for traders out there who are, and also those listening to us. Yeah, you can check out these two books. They are books under the Wiley Trading series. Really, really good books that you can check out. One of them is Enhancing Trader Performance. Those of you that were with us at the beginning of the webinar, we shared a quote from there on how competence supersedes confidence. Yeah, so Enhancing Trader Performance, there are proven strategies from the cutting edge of trading psychology, and the author there is Brent N. Steenberger. Then we also have a really good one, which is the New Trading for a Living. It's a book on psychology, and it also includes actually for him, his philosophy is that psychology, discipline, trading tools and systems, as well as risk control, are what perhaps encompass an entire trader. A full trader should have all of these. Yeah, so I think most times we tend to focus on the actual act of trading, which I think really is something simple, because you're just going to go and buy and sell. And guys, I'm not meaning like, I don't mean like the act of actually trading. I mean like the act of trading where you click buy and sell buttons is something simple. So we should be focusing on other things like analysis, like improving our discipline, improving our psychology. Robert mentioned something which is very crucial as about maintaining a positive mindset. Your life should not be entirely about trading, guys. You should be a trader, but you should know you in other aspects of your life. You could be a musician when you're a trader. There's a clinical psychologist called Gary Dayton who was also a trader. There are traders I know that are architects. There are traders I know that are farmers. So you shouldn't be trading full time, trade, but also have something else you're doing. And also for those who are full-time traders, do not trade the entire time, have other activities, because all that then at the end of the day helps you to become a better trader. If other aspects of your life are doing fine, then, you're not in the markets the whole time. Trading is just a part of your life. It's not your entire life. Yeah, that's what I have
Awesome,
to say.
awesome, Norbert. If I were to add a book, I would probably think of also Trading in the Zone by Mark Douglas.
Oh yes, really good book.
Trading in the Zone, especially the exams that you do at the beginning, and then you read the material, and then towards the end you realize, okay, so I was so wrong on so many things. So that will be also something, guys, that you can look into, so that you're able to improve on your trading psychology. So this brings us to the end of our presentation. I would like to thank my colleague Nobert so pretty much. Uganda well represented. I can see Rita is all up in arms.
Yeah. Thank you everyone in the comment section. We have seen also, Robert, someone is asking, what time frames do you recommend for moving averages?
Wow. Okay. Moving averages are best. They have high probabilities when they present themselves in higher time frames, right?
Yeah.
That's when, if you're looking at opportunities for support and resistance, if you find them, let's say on the monthly, daily, weekly, they tend to be more stronger. Yeah. So that is probably something. But hey, Annette, Terry, kindly visit our classes if you are able to. Come to Thika, come to Eastleigh, come to Nairobi. I'm guessing you're a Kenyan, because this presentation has a Ugandan team and the Kenyan team, which is something mixed match, quite an amazing presentation. So wherever you are, Uganda, Nobert, tell us, where are you guys in Uganda?
Yeah, guys, I'm happy to say that FX Pesa is soon launching in Uganda. It's actually already set up, but we're in the process of launching as we get ready for you guys. We're going to be located at Rumi Building. That's along Lumumba Avenue on the 7th floor. And we are going to be having physical training. So feel free to come and check in on us. Let's discuss, let's, dissect the charts and see how we can, help you guys to trade better and make some money trading. Yeah, and just keep our social media channels close by, and get, keep informed on whatever it is that's coming your way. Yeah, thank you so much, Robert.
So Norbert, maybe you can share the socials for those of you guys who probably would want to see our socials, FX Pesa. So
yeah, let me do that real quick.
Have a look at those socials. You can also what's the London kill time, Michael Charles? Basically, this is the time when opportunities present themselves due to new volatility that is coming in from the London traders or even the New York traders. So anytime when the market is opening, that's why actually you'll find there's a strategy called the London breakout strategy. So there's that whole kind of manipulation that happens before the market settles in. And then if it was a bullish trend, then you have that bearish retracement trend that is meant to trap guys to go short. But then again, we see a bullish candle, maybe a reversal, a bullish engulfing presenting itself. And all of a sudden, the trend continues in a bullish trend.
Oh, yeah.
So that's basically more about it. So guys, thank you for your time. In Kenya, guys, visit our satellite offices. I am in Thika. You can visit our offices in Eastleigh, in Nairobi, Westlands, Kitengela. You can also visit Nakuru and Eldoret. Otherwise, cheers, guys, for taking your time to be with us in this presentation. We look forward to having more of these presentations. Make sure that you're going through our webinars, FX Pesa webinars, and you'll get to learn so much more. Otherwise, Nobert, what's your take? Maybe tell us bye-bye in Ugandan.
Sorry, just come again on that, Robert. I didn't get that.
You can tell us bye-bye in Ugandan. For
Bye
Ugandan
bye,
guys.
bye bye in Luganda. How can I say that?
In
There's no
Kenya
particular
we'll say
word.
kwaheri. In Kenya we'll say
Oh,
kwaheri. Tuonane
okay.
on Wednesday. I'll be here on Wednesday, guys. Anyone who's interested in phone trading, that's the
Yeah.
topic we'll be covering with my colleague
Awesome.
from Eldoret. So cheers, guys. Have a good one.
All right, guys. Thank you so much, Robert, and have a good one. And thank you so much, everyone. Yeah. Cheers. Yes, Robert.